Everyone is celebrating cooling inflation, but commercial real estate isn't celebrating yet, because the number that really matters for interest rates isn't the one that's falling. The latest inflation data is sending two different signals. The Consumer Price Index, or CPI, came in around 2.4% year over year, continuing a steady cooling trend. Core CPI is about 2.5%. The main reason is housing. Rent growth has slowed sharply, with shelter inflation now near 3%, the lowest level in 4 years. That slowdown is largely the result of the massive multifamily supply wave finally hitting the market. So from a CPI perspective, inflation looks like it's coming under control. But the Federal Reserve pays closer attention to core PCE, and that number is still running around 3.1%, well above the Fed's 2% target. This gap between CPI and PCE is the key signal. Housing inflation is falling, but broader services inflation is still sticky. That keeps the Federal Reserve cautious about cutting rates. So even though one inflation measure is cooling, the policy signal the Fed watches most hasn't moved enough yet, which means interest rates may stay elevated longer than markets hoped. For commercial real estate, the constraint right now isn't tenant demand. Leasing in many sectors is still stable. The real constraint is financing costs. Higher interest rates continue to slow development starts, refinancing activity, and transaction volume. Deals today often don't fail because the asset is weak. They fail because the debt structure no longer works. But until broader inflation moves closer to the Fed's target, capital costs remain the real pressure point for commercial real estate.